gone down to West Wales and you've found a block of 40 flats that are all on one title, just one freehold of that big building.
Yeah.
Wow. I'm like absolutely incredulous that someone out there would have owned that and not split them already.
Why would you not split that? Because surely you would know if you're...
You've got a block of 40 flats for 1.4. What was going through your mind then when you're going through it?
Yeah, we were only able to buy it because we knew anything above 1.9 million meant that we were putting no cash into this. And it came in at 1.875 million.
The key to all of this is having your solicitor in place who's going to be able to do the bit at the back end. But the finance is the thing that's made this work for you in terms of the products that are available.
So it's understanding the finance market to get the right products, you're right. Having a fantastic solicitor, that is a problem. And the other bit is the valuation. There's two parts to that. The first part is
building wealth through property isn't about chasing big deals and paydays. It's about owning assets that make money for you consistently. But figuring it all out on your own, that's where most people get stuck. That's why we created this Property Life membership. It's everything we wish we had when we started. Expert guidance, real-world case studies, and a private community of investors actually doing deals, not just talking about them. So you could spend years trying to piece it all together yourself, or you could plug into a system that's already working for our community. Check out our membership page at This Property Life. Everything you need to know is right there. Success is a team sport. Come join in.
In this episode of This Property Life, I'm joined by James Lynch, a property investor and title split expert who specialises in finding hidden value in deals. So we're going to talk all things title splits, what they are, when to use them, how this strategy can help property investors accelerate property growth. So James is going to explain how buying blocks of apartments and titles can unlock instant value and open up refinancing opportunities that will fuel faster growth for you. We're going to cover what title splits are, maybe with an example or two, how to structure the strategy, the legal and practicalities that you cannot ignore, and how to spot opportunities that others may miss. So if you're looking to squeeze a little bit more value out of your projects or just want to understand the strategy better, then this conversation is packed with insights. And I'm really excited to get going. So I'm your host, Sarah Blaney, and let's dive in to title splits. Welcome, James, to This Property Life.
Thank you, Sarah. Thank you for having me.
Heads up before we start the show. This Property Life is more than just a brilliant podcast. We are also a thriving network community. We meet online every single week with different property experts and in real life every single quarter to share war stories and insider tips. And the best bit is you can get this absolutely free for 2 months. So head to the link in the description and start networking smart. You're more than welcome. So you are based down in the southwest, aren't you? You're down around Bristol.
That's right. Yeah.
And is your portfolio based down there as well?
It's not, no. So we started a portfolio in Bristol because obviously it's where I've been living the last 25, 30 years. Got to a certain sort of point with the Bristol portfolio, but then title splitting literally took us on a journey. I know it's a cliche, but it was a journey sort of down the M4 and beyond. So we've now got quite a large number of units in West Wales, so Pembrokeshire, more recently or very recently Port Talbot, and then we've got a few in Abergavenny, which sounds like a very random little location, but it's a beautiful little town and it's only an hour from Bristol.
Oh, okay. So, and what's the connection with Wales?
So I'm from South Wales, from the Gower, so
Natural choice,
yeah. I think as well, you don't have to know the area that that you're buying these blocks in, but for things like getting the valuations right and understanding the good part of town, the bad part of town, how the values might vary street by street or area by area, it does help a bit, definitely.
Yeah. Okay, so let's get into title splits because it is sort of a phrase that's thrown around in the property world and people kind of go, oh, yeah, you should title split that. You should do this, you should do that. And, I don't know that everyone truly understands it. I mean, I've done a number of title splits over the years, but I think mine are going to be quite different to the ones that you maybe focus on because mine are all vertical title splits rather than horizontal title splits. What I mean when I say that, for anyone that isn't looking at my hands doing it all, is I've got a property that I'm going to split vertically, so each of its footprints sit on the ground, whereas if you're splitting a block, you're going to go horizontally so that the basement of each property might be on top of each property. So that's kind of the difference, isn't it, between the vertical and the horizontal title
And
split?
that's a really good distinction to make as well. Title splitting, really, which is the term that we all use. It is more what you're talking about, right? It's the freehold split or the TP1, transfer of part, that sort of thing, where you might divide off a garden from a big house to go and build a second dwelling on it or whatever. And that really, I think, is probably the correct use of the phrase title splitting. But typically these days, the sort of the buzz around the words is people, not always, but it's very often, people like me buying a block of flats, and as you say, chopping those out from top to bottom so that you've ended up with 10, 20, whatever it might be, leasehold flats rather than different freehold titles. And that's sort of
Yeah,
largely what, I'll be talking about today, that sort of leasehold
yeah.
creation. Yeah.
And obviously, that is a far more complex process and lots more moving parts than when you are actually just splitting up, a freehold into further freeholds and parcels of land.
Definitely. Yeah. I mean, I sometimes get people asking me to sort of, to consult on the freehold title split. And, I have done, but it tends to be a fairly short client engagement because there isn't really a lot of complexity in there whereby, the leasehold split, it's, you may need to go and get measured surveys. You might, you need to understand how the communal parts work. And, quite often we tend to do this on the way into the purchase. So it's all a bit of a rush as well. And it's a case of getting things aligned with, the right solicitors, the right lenders, getting those surveys done all in quite a short space of time. So definitely it's a more complicated process. Yeah.
So you mentioned that, you kind of went on the journey and we all hate that word, but sometimes you just have to use it. So like, what was the start of that? How did you even like start in this area, and why was it something that you kind of followed so, in such a niche kind of way?
I suppose it was an accident, if I'm honest. Well, not quite an accident, but probably had what, about 5 or 6 properties in Bristol. So, we were sort of, had a small portfolio. This is myself and my partner, Laura. We were still working in, day jobs in project management. And just before COVID, we found a little block of flats. In fact, it was 2 3-bed flats and a little parcel of land as well. And we bought that. I think we actually bought it probably, just at the start of COVID. Anyway, it turned out to be the best investment we'd had. It had all the financial benefit of a HMO, basically, with none of the drawbacks. So it was 2 groups of 3, and they were established groups that came to us as friends. They were sort of early 20, young professionals coming out of uni, going into fintech jobs, I think it was. And, they always paid the rent on time. Obviously, they paid their bills because it wasn't a HMO, it was a flat share. It cash flowed like a HMO without any of the hassle. And we were like, well, this is what we should be doing. We should be buying blocks of flats because clearly this is a much better model. So, as I say, we were still in day jobs. At that point, we hadn't even sort of cracked the ways of keeping our money going. The momentum investing wasn't really something that I think we probably understood how to do it, but we hadn't done it. So, like, right, how do we buy blocks of flats? We haven't got a lot of money, and we're still working as well. So I went off on a bit of a sort of research rabbit hole and basically found title splitting as a way of buying a block of flats without actually putting any of the deposit money in. And that was sort of eye-opening, right? Because once you've got to that point, then you're like, well, I'm only being limited by my own imagination and then stamp duty and legal fees. So, that's a much smaller amount of cash than, putting 25% in every time. So obviously these opportunities aren't just sat there waiting for you to come along and grab them. You do have to do a fair bit of searching. And so our search initially, we said we looked like an hour and a half radius, basically, of Bristol. Almost bought a block down in Torquay. Vendor pulled out for capital gains tax reasons, decided he didn't want to pay his tax bill. I do wonder if I should get back in touch with him because it's been a few years. Maybe he's changed his mind. And then ended up with this massive block down in West Wales, 40 flats down in West Wales. And I mean, clearly, some of the costs there weren't insignificant, but at the same time, because it was 40 flats and the particular price point we were at, the stamp duty or land tax down in Wales was £14,000 for the 40 flats for the £1.4 million purchase. Legal fees were a bit strong, probably stronger than we'd pay these days, but it was our first one. Our first title split was 40 flats at 1.4 million.
You've gone down to West Wales and you've found a block of 40 flats that are all on one title, just one freehold of that big building.
Yeah.
Wow. I'm like absolutely incredulous that someone out there would have owned that and not split them already.
I know. And yeah, why would you not split that? Because surely you would know, if you're in property to the level that you're able to buy a block of 40 flats, then surely you'd know the uplift about splitting them, right? So as you say, it sort of blows your mind that someone could not know. Now, to take that step further, the guy we bought it off was a RIC surveyor, a working RIC surveyor.
Wow.
Yeah, I know. I still think about it myself every now and again and just try and work through.
Where was it advertised on the portals? Did you find the property that way?
So that one was sourced, the sourcing company
Yeah.
sourced. So they have their app. I hadn't looked at it for probably, I don't know, 9 months, a year at that point. And I literally loaded it. It was September 2022. Loaded it that day and thought, I'll have a flick through, see if there's anything. And it's that Tinder style app, swipe left or swipe right, depending on whether you like the property or not. And I'm just going through, sort of swiping, going like, yeah, none of this is of any interest. And then there it was, 1.4 million, 40 flats. I didn't have to get my spreadsheet out. I didn't have to get the calculator out. It was just like, that's amazing. And I looked at the date and it had been posted on the app that day. So I was like, right, I'm not too late, in case everyone else is thinking the same thing as me. And I didn't do whatever you're supposed to do with the app, probably a couple of buttons or something. There was a phone number in there somewhere and I just phoned the guy up, Josh, and, sort of introduced myself and basically said, yeah, it's, we're going to be getting to know each other over the next few months because I'm buying that block of flats through you. And it turned out 50 people expressed an interest that day.
I bet they did.
Yeah. So I had to sort of elbow my way to the front of the queue and just, everything they asked for, documentation, ID, whatever, they had it within 20 minutes. And we just treated
So you've got a block of 40 flats for 1.4. So they're, what sort of size are they? 1, 2 beds?
I think they're mainly 1 beds. I think we have perhaps 6 2 beds.
Okay. And were they all tenanted?
I think we were at about 32 out of the 40 when we bought it, which was fine. You inevitably get sort of a bit. It turned out we didn't really appreciate at the time, but 2 of them were in fairly bad condition, cosmetically in fairly bad condition. But that was fine. It was all baked into the price. So we were happy.
Okay. So they're £35,000 each, generally. With your legal fees on top, obviously, and that massive £14,000 stamp duty. I can't get over that either. That's incredible. What was going through your mind then as you're going through it? Did you immediately think we should separate these out and look at each individual value?
Yeah. So we were only able to buy it because we knew there was at the time it was bridge. So there was a bridge product. They'd lend you up to 70% of the GDV and they would max out at 100% of the purchase price. So, I absolutely went through, worked out those values flat by flat. And I did that in numerous ways because, it was the first one. I'd never done this before. So at the time I used to use a software tool called Landworth. I don't really use it anymore. It still exists and it's okay. But yeah, Landworth. So I worked it through on Landworth. I downloaded you can just download CSV files from land registry for a given postcode, etc. So I did a lot of that, played around with the raw data. Obviously I think I was using Nimbus at the time, so I might have run it through on Nimbus as well.
Could have asked that RIC surveyor that was...
Yeah, I know. And I came to all sorts of different values from the different ways that I was doing it, but they were all between I think 2.2 and 3.6 million, no matter how you cooked it. So I think it was 2.1 or 2.2 I asked for, or maybe 2.3. I can't remember now, for the valuation.
This is to the bridging
To the
company.
bridging company, yeah. So that was the next step. It was because we'd had the dry run. We'd almost bought this one down in Torquay. I already knew which solicitors I was going to use. I had the broker I was going to use. I knew the process, so it was. I mean, it was still a big, scary thing to do, but it was quite good to have had that dry run and have everyone's phone number and email address ready and just be like, right, it's happening, we're doing it. And so we got the valuation booked in. I mean, obviously, we went down and saw it. It was a massive block of 40 flats for 1.4 million. So, tick. It was exactly what we expected it to be. Amazing building as well. I mean, it looks like something out of Hogwarts. It's from 1902 or 1903. It's got twin towers, castellated towers. It's a hell of a thing. So it was getting finance was first step. So we got the valuer booked in. So the end of September 2022 that we were viewing it, we saw it on the app and then went and viewed it within a week, I think, within a few days maybe. And I'm sure everyone listening to the podcast is thinking, oh, well, that was a bad month, wasn't it? Because, the end of September 2022 was the trust's quasi budget. So our valuer went in second week of October, something like that. And, at this point, it was doom and gloom across the property industry, wasn't it? You were losing mortgages, you were losing debt finance, people were walking away from deals. I was confident I did not want to walk away from this. It was still an amazing deal no matter what was happening. People are still going to need somewhere to live, even if they've got COVID. Right? Sorry, even if they've, that too. But even if the economy's tanking. So we were sticking with it. Our lender, fortunately, was willing to stick with it as well. The valuer did react to the uncertainty quite harshly. So when the valuation came through probably a week later or whatever, I'd asked for, I can't remember now, 2.1 or 2.2 million, something like that. Anything above 1.9 million meant that we were putting no cash into this. And it came in at 1.875 million. So initially I was gutted. I was really, because I was like, it's got to be, 2.1, 2.2. And I was absolutely gutted. And sort of Laura, my partner, it was a Friday afternoon, the report landed. So it was, Friday evening reading it. And it was, you do realize you're really upset that they've only upvalued it by, 0.475 million. I was like, yes, you're right. Okay. Yeah. The champagne can come out. We can celebrate. And there was a gap to close, but it was such a good deal that private lenders were easy to find, and we just closed that funding gap with a private lender.
Yeah. So the process is that you've found the property, you're going to split it. You've found the finance solution that's going to basically give you more or less most of the money to buy it with, and then you funded the gap with private money, angel investment, and then as you're going through that conveyancing process, are you buying it on the bridge as it is and then splitting out afterwards?
No, so it's and this is the way we've done all but one of them. We've done the same way, which is simultaneous purchase and title split on the same day, so on the day of purchase completion. And the reason for that is the lenders will, well, back then it was 70% LTV, it's now 75% LTV on bridge or even on mortgage in some cases and obviously they cap it typically, not always, but typically they cap it at purchase price. So by doing it on the day of purchase completion, the lender is never at risk because the solicitor is given an undertaking to say, we will split this simultaneous with the purchase. So the lender's like, right, okay. And the RIC surveyor said, well, here's my report to say it's going to be worth this bit more when it is split. So as long as you got the RIC surveyor report to say it's going to be worth that higher amount, you got the solicitor saying, well, here's my undertaking to say I will do it simultaneous with purchase completion, then the lender isn't at risk for a moment. They've got their 75% LTV from the instant that funding is against the property.
So I'm going to dive back into the legal process because obviously that is probably that lawyer, that solicitor is your best friend during out this whole process. He or she is your absolute key player. So we'll dive back into that, but let's just go at a high level. So on the day of purchase, you're still with this broker bridging company, and there is a simultaneous title split, and it becomes 40 individual titles, and it's a freehold leasehold. Just let's go through, because obviously that is in itself a big story, but let's go forward a little bit, and then tell everyone what happens next. How do you exit that deal?
Yeah. Okay. So yeah, day of purchase completion, as you say, it's now 40 leasehold flats, and it has entered our freehold company. Again, I'm waving my hands around now, which no one on Spotify is going to know, but yeah. So it's now entered our group company, sort of the top of our group structure, and then we've granted the 40 leases down to a subsidiary company, which is where the leaseholds sit, and which is where all the value is and where the mortgages end up in the future. But for now, it's entered into the freehold company. So we're now, we've moved them down. Obviously, there's a debenture against the whole group at this point, and we now need to get those titles registered at the land registry as quickly as possible, because nobody is going to refinance us off the bridge until we've got titles in hand. And as I'm sure everyone's been through it, you let land registry do things at their pace, and it'll probably take about 18 months, 2 years
Yeah,
if you're
well,
unlucky. You don't want to be on a bridge at typically 1% a month for 18 months, because that would be disastrous. So you go in for the expedite. We did that. So that was, there was some other stuff going on, like we were filling the 8 remaining flats. We were meeting our letting agents, who turned out that we inherited from the vendor, who turned out to be amazing, which made life easier. So we were filling the voids. We were doing some maintenance work, a bit of like refurb, but we probably spent 40 grand, maybe something like that. It wasn't anything massive. And yeah, the target was within 6 months we'd finance out onto mortgage. It was actually, I think, 7 months, or just over 7 months in the end. And obviously then we were moving to mortgage. There's a few ways you can do that. You could literally go out and get 40 individual mortgages. I didn't fancy signing my name 80 times, right? One's for the freehold company and one's for the leasehold company. So, at the very least, we were thinking 4 slices of 10 or 2 slices of 20 flats, whatever, break it down like that. In the end, we ended up with one lender who would lend on all 40. People might be able to guess who that is, because it's the obvious name for taking a massive portfolio like that. So it was Shawbrook.
yeah,
And the rate wasn't, I mean, it had gone up a bit because Trust and Quasi had killed the economy, but it wasn't horrendous, to be honest. I think it was 6.25, if I remember rightly. And they took the whole lot. And obviously we had another valuer go in because they wanted valuation as well. So I think this time I wrote it at the 2.25 million. So it was probably a little bit higher than it was before. Market had stabilized, right? People weren't panic stricken. They didn't think, the world was going to end. Rates had gone up, but that was about it. And yeah, he agreed with my 2.25 million. So we had all money out, because we were now at 75% LTV with Shawbrook. All money out and a bit left over as well.
yeah. So at that point, you pay your bridging company off. You
Yeah.
now have one new lender on a normal
Yeah.
mortgage, albeit obviously a slightly different product to your standard buy-to-let, because there's 40 buy-to-lets within there.
Yeah.
And then you're just on your merry way.
Exactly that. Yeah, the differential between, fully rented and what we're paying on the mortgage was massive. So it all worked out very nicely. Yeah.
Yeah, and suddenly your portfolio's gone from having 5 in Bristol
Yeah.
to having 45.
Yeah.
Which step up overnight, isn't it?
Yeah. Yeah, absolutely. It was literally life-changing, because along that period of time, we'd been talking about quitting our day jobs and, being in property full time. Laura, I think, had quit just before. So she quit, I think, perhaps while we were chasing the Torquay property. And then I'd quit the couple of weeks after the valuer went in the Trust Quasi month, which was a little bit uncomfortable, because people were sort of terrified. I mean, October was terrifying, September 22.
It
Right?
was an awful time.
Yeah.
Yeah, absolutely.
So that's when I left my comfortable, safe job to enter the property world.
Excellent. Okay, so we've got this overview of a 1.4 million purchase up to a 2.2 million, and basically you've released all the money that you've ever spent on it. So that's your legal fees, the bridging interest was accounted in that or not?
I think we probably on that one. I think money did go into the bridge, yeah,
Servicing that
to
loan.
service the bridge, but we were getting quite a lot of income off the bridge as well.
So it sort of offsets it a little way, doesn't it?
It probably
Um,
just about. We probably paid a bit, but yeah, not a big
yeah.
amount.
So basically, we could kind of say that at the end of this process, you've gained 40 tenants, 40 flats, and you've paid a few thousand for
Yeah,
them.
legal fees and stamp duty. Yeah, it was pretty
Yeah.
affordable. Yeah.
So obviously, everyone can sort of go, wow, I want a piece of that. That sounds amazing. But there were complexities, I'm sure, and a few moments throughout that where yourself and Laura were probably like, have we taken on too much? Was this too big? And there's a few scary moments in most property purchases.
Yeah.
But when you're doing your first over £1 million transaction, it's probably a little bit more, oh gosh, what's going on? So let's dive into the legal bits of it all, because we've skirted over and said, so yeah, I've got this freehold at my group structure and there's 40 leaseholds, but there's a little bit of work in that, isn't there?
Yeah. Yeah. So effectively, then I suppose to carry on the story from the point of the valuation, we had a successful enough, shall we say, valuation back. Closed that gap on the funding, so it was like, right, let's get on and do this, right? So it's now middle of October, late October. I think the vendor wanted it done by Christmas, don't they always? We hadn't told the vendor that we were title splitting. I mean, why should we, right? I mean, that's our own, private finance matter, really. So the things that we needed to do, we needed to get leasehold plan. Well, we needed to get leases drawn up. Obviously, the first bit, getting the leases drawn up is relatively straightforward because, of course, any decent solicitor's got a template to work from that they've used before. They need some input from you on the boring stuff, like where the bin stores are, and the fact that you can only park your bicycles in the back or whatever it might be, or that you may have a parking space demised for, flat number 1 might have parking space A or whatever, all that sort of boring stuff. And then you've got to get the actual leasehold plans done, which are those, the red line around the outline of the flat itself, not the overall block. So 40 flats, 32 tenanted. We haven't told the vendor at this point what we're doing, and he happens to be a surveyor. We had said, as part of the offer, there will be surveys and, so on and so
Yeah.
forth. But this is still going to be an expensive and time-consuming exercise, and all it takes is one tenant, taking the attitude of, no, you're not coming in, and we're stuck, right? So, and this is a top tip, really, like, one of those sort of lean in, don't tell anyone top tips. We went on to the planning portal and looked up the block of flats on the local council's planning portal. And it turned out that, it had only been converted in 2015. So we went and looked up those, or conversion had finished in 2015. I think planning perhaps had gone in 2011. So we looked up and found out that the architects were, I think they were like 10 doors down from the building itself. So one of the times when we were going along to view it, maybe I'd phoned before, but basically we walked into this very old-fashioned Pembrokeshire architectural practice and said, we're buying that, the massive old school just up the road. Hoping to get some leasehold plans drawn up. We saw on planning portal that you were the guys that did the conversion plans. I take it you've still got the AutoCAD on your servers somewhere, and you could just draw a red line around the outline, put a bit of extra detail on to the land registry standard, and create those. And they were like, "Oh, absolutely, yeah, of course we can." And I think they charged us like 2,000 or 2,500 for all 40. So that was a massive win. So yeah.
You haven't had to try and organise 32 tenants.
Yeah, exactly. I mean, that would have just been, we didn't see all 40 flats. I still haven't seen all 40 flats to this day. So yeah, that was a massive win. So obviously they went over to the solicitors. The leasehold creation, wasn't, when push comes to shove, you could probably get a solicitor to do it in 5 days or something. It's not a massive job. It's just churning through, and they need a few trainees doing some late nights, but you know what I mean? You could get it done quite quickly. But we also had 32 ASTs to review, EICRs and so on and so
All the
forth.
compliant. Yeah.
All the compliance. The documents were being sent from the vendor solicitor to our solicitor in boxes, like the old cardboard boxes of, I think there was like 3 or 4 of those being sent, and they were copies, obviously, because they said it was too much data to transfer. I mean, it seems a little bit unlikely, but the first lot went missing. So they had to go and copy it all again. And this dragged on for like 6 weeks, I think, in the end. It was ridiculous. It was like,
Take your boxes.
yeah. And, because I think, I can't remember, it was the locations involved. Oh, that was it. It was Manchester and Birmingham. My solicitors were in Birmingham and the other solicitors were in Manchester. It was just like, I mean, what's a motorbike courier? Well, probably too big for a motorbike courier, but what's a courier going to cost? Like 300 quid or
Yeah.
something,
You should have got a van, James,
Yeah.
and just nipped up and done it yourself.
Yeah. So that slowed everything down. Just, effectively the vendor not getting us the information is what it came down to.
Which is often the case.
Yeah. Yeah. It's always our fault as the buyer, right? But
Yeah.
it's often the vendor who wants it done tomorrow.
So the things that you've got to get like lined up, your ducks in a row, is your structure. So that's you're in a group structure. So you'd had that organized already, so that your group at the higher level is going to be the freehold, and then you've got a company down
No,
below.
there was a bit of a problem with that as well. So
Oh, okay.
we had a relatively well-known property accountant that we'd had for about 3 years at that point, and we were happy with at that point. And, we're now jumping from everyday deals to this massive deal. And I was like, right, I need you to advise me on group structure. I've done my reading on it, but I'm not an accountant. You need to sort of advise me what the best way of doing this is. Is it the top co, bottom co, which is what we did go with and what I sort of felt was probably right? Or some people do a side by side, as they call it. We have a holding company and then you have your freehold lease company below. And he just said, oh, we don't advise on group structure. I was like, right. I don't even understand who else is going to advise me on group structure. I think he might have said your solicitor should, and it's like, well, it's definitely an accounting matter, not
an accountant.
Yeah. And I think I asked, between verbal and written, I think I asked like about 3 times, 4 times. And the last one was like, just to make it clear, I have to have this advice. This is a massive deal for me. I can't progress without advice. If my accountant won't advise me, I'm going to have to find an accountant that will. And it still came back, we don't advise on group structure. I was like, right, okay. So halfway through this deal, we had to dump our accountant and go and find a new accountant. There were 2 sort of pretty well-known people in the property industry that I knew at that time, and I asked them both for a recommendation, and they both came out with the same name. So I was like, right, that's who we're going with.
Good enough. Yeah.
And yeah, totally the right decision. I think phoned me back within about 24 hours in the evening as well. I can remember I was at a property event and I had this phone call and we were talking through how to do it sort of from the foyer of some property event. And yeah, plain sailing ever since. But it is just another illustration of, making sure you've got the right professionals. I thought I did, but making sure you've got the right professionals for this sort of thing.
Yeah. So you've got what you're calling a top co, bottom co structure. Your solicitor is busy writing out 40 leases. The architects are busy doing the land registry drawings. Was there anything weird that you fancied putting in your leases? Did you like ban Airbnb and SA, for example?
No, we have since we have sort of crafted in some terms like that, I think, where it's, sort of things like, serviced accommodation only after freeholder consent, just in case we wanted to sell off half the leasehold flats, which we could do as to raise some capital. Then we could choose whether or not we wanted the flats being used for service accommodation, either because, they can be a bit disruptive, can't they? Or because maybe we want to do some service accommodation in ours and we don't want the competition. So,
Yeah,
um,
no, that
but no,
okay.
we haven't put anything too quirky in there. But I like that. Yeah, that sort of appeals to my sense of humour to have something really random in there.
Yeah, I just think it'd be good fun. But
Yeah.
anyway, really, that's where both of us are, James, on that sense of humour. So all right, so we've got our counting done. We're doing our drawings. The solicitor's doing his bit. Your broker is obviously finding that exit finance for you, which happened to be Shawbrook. Was there anything else in the mix that you're having to manage at that time?
The biggest thing was probably the vendor's expectations, which was, sort of, he had a point to an extent, but like I say, he delayed us, whatever it was, 4-6 weeks with a document arrival, which, he was not taking responsibility for. It's like, oh, it's in the post, sort of attitude. And then he really wanted the deal done. And as time went on, he clearly did think that we were pulling out or that we didn't have the money in place. And it was like, no, it just really does take this long, especially when you've taken 6 weeks to, to do this. And it wasn't about the leases, they weren't the factor. There was plenty of stuff that the solicitors were finding that was problematic, standard problematic stuff that you get almost on every deal, right? But times it by 40, and it was enough just to keep the clock ticking, basically. I remember there was one thing where there was one flat where the EICR had expired. Interestingly, Wales is usually ahead of England with legislation for whatever it
Yeah,
might be, fire or safety or whatever. With EICRs, Wales was behind England. So actually, I don't think at that point in Wales we legally needed an EICR for that flat. But because all the solicitors were English, the lenders were English, and so the idea of not having an EICR was just too weird to them, so they wouldn't allow it. And obviously you should anyway, but the reason it had expired was because the guy in this flat was difficult to the point of being dangerous, like as in criminally dangerous. Yeah, the previous owner had an awful taste in tenants. I think it was like, if they have a pulse and they have the first month's rent, they can move in, basically.
yeah,
And this guy was, criminal record longer than my CV. It was ridiculous. And there was no electrician in the area who was willing to enter. I mean, he wouldn't have let them in anyway, but they weren't willing to enter the flat. So that almost derailed us. And we were at one point thinking that was going to be the problem that sunk it. And then the lender said, I think you've got like 30 days or 90 days after completion to solve it. And we're like, okay, let's push that huge problem down the road. Although I've
yeah.
got no idea how we're going to fix it at this point. And other than that, it was just the usual little problems that you get. What became a problem, though, was that the vendor literally was getting to the point of wanting to pull out. And I was like, he's just being difficult. We had, of course, a sourcer in the mix here, and there was actually a number of sources, as quite often ends up on these big deals. And the one that was closest to the vendor, a guy called Richard, it got to the point where I was probably speaking to him every day. And he contacted me and he was like, I don't think he's bluffing. I think he literally is going to pull out. And by now we'd got all the way to February. So in fairness, like, it has dragged. And I can remember having a conversation on the phone with the broker where I'm saying, like, where is the funding? It really needs to happen. The sources are convinced that he's going to pull the plug. And the broker was speaking to me from, I think, perhaps the toilet of the restaurant where he was taking his wife out for Valentine's Day. But still took my phone call. It was very good of him. And I can remember then he connected me with the business development manager of the bridge. And I was talking to this guy, again, another good guy. And he was like, yeah, they're sitting down with the ultra high net worth individual this morning in, I think it was Singapore or something like that. And I was just like, right, why are they sitting down with him at this point? Surely you just need to be transferring money. And they were like, well, they're going through the slide deck. And I was like,
Oh,
so what?
wow.
They're pitching him at this point to lend the money for this block. So it was like, right, okay.
That is not what you want to hear.
No, but It got sorted. The money was lent. Everyone did what they said they were going to do.
Yeah.
But it was the levels of stress were fluctuating, as you can imagine. So,
Yeah.
yeah,
And actually, the levels of stress weren't even about anything to do with title
no,
splitting.
no,
It's just the normal conveyancing
yeah,
process and lending process.
yeah, yeah. We learned
Amazing,
so much on that deal. We learned so
I
much
bet.
about how much, well, all finance and property, but bridge especially, is about relationships and knowing people. It's not this massive company with rock solid processes that you think. It's very much about you proving yourself as being capable of taking on this project, and them having belief in you, and then people will lend, basically. And also, my background was project management in complicated, stressful, highly regulated industries like aerospace, like oil and gas, semiconductors, where delivery and safety are massive factors. And the amount of money that people lose if you're 2 days late, it can be like $2 million a day in liquidated damages and stuff like this. So I had this head on already, that sort of made me think, right, when we've got to deliver, we've got to deliver. It's one thing when it's $500 million of someone else's money, and it's another thing when it's 1.4 million pounds worth of not your money that you're trying to borrow to do a deal for
Yeah.
20 grand, sort of thing.
Yeah,
There
absolutely.
was definitely a
So
couple of
when
sleep
you look back on that deal, obviously it is the one that changed the course of both of your careers because you were able to give up those previous careers. It's obviously been it's the linchpin to everything. Oh, there you go. What did I do there, James Lynch? um, but yeah, equally, did you look back on it and go, I should have done this, or this was a mistake that I learnt from?
I don't think. I mean, yes, there's a lot of things we've learned from the process, but I don't think there was a lot that we could have done differently at that time. There's definitely ways I could save money doing it today versus then.
Yeah.
And some of that is my knowledge, and some of that is the way that the finance market's evolved in that time. But yeah, I could definitely save money. I could definitely do it quicker now. But no, I think, by and large, all the people that we worked with on it were fantastic. The rates we paid overall were actually not that bad. For a first massive deal, you'd have to say it went swimmingly
It
well,
went okay.
really. Yeah.
Yeah. So let's like dive back into the title splits because that story is absolutely fascinating. And honestly, I reckon we could talk a little bit more about that. But we are supposed to be talking about title splits. So that was a big building, 40 flats. I've got multi-unit blocks, but none of them to that size. They're sort of, 6 to 8 flats. And I've never split the titles because it didn't seem worth it. And actually they work really well as they are. But is there a magic number of if you're looking at a property and it's got X amount of units in it, is there that magic number for you where you go, yes, I'll split because of this, and I won't split because actually it's too little. The GDV of those flats are too little.
As far as magic numbers go, in England, 6 is nice because then you're on commercial stamp duty. And, depending on what part of the country you're in, and hence the prices, that can have a massive difference. So, for example, I live in Bristol. A lot of people will have heard of Clifton, most of the high value area in Bristol. I looked at a block of beautiful 4 flats right in the middle of Clifton, for 1 million about a year or so ago, because it was 4 flats not hitting commercial stamp duty, and obviously MDR in England got taken out a couple of years ago.
Yeah.
The stamp duty was 92,500, which has gone up a little bit now. It'd be 93,750 these days on 1 million. That's deal killing, it's really hard to get that to work. But if it had been 6 flats, and again, 6 flats for 1 million, still a very realistic thing. Probably wouldn't have been in the middle of Clifton. It might have been on the edge, or even elsewhere in Bristol. That stamp duty would have been 39,500, being commercial stamp duty. So I do sort of teach people not to get too fixated on the 6 plus thing, but yeah, you've got to be aware of that difference in stamp duty. We've done blocks I think the smallest we've done is 4, and the biggest obviously is 40. We keep finding, and bear in mind, we do stuff in Wales where multiple dwelling relief still applies, and often where prices are that bit lower anyway, that stamp duty isn't too much of a driver like it is when we buy in Bristol. But we keep finding a lot of 5s and 6s. They're great to split. We bought a block of 9 last month and we didn't split it. So it's the first thing for a while that we've not split. And the reason we didn't split it was because we got it for such an amazing price. There was no benefit in doing the split. And it was also with a housing association, and it would have been a bit disruptive. And it was just like, let's just buy it. It's a fantastic deal. Let's buy it and then worry about anything else in the future. But that's sort of, if we haven't sort of said it already, that's pretty much why we split, is we can then put zero of the purchase price in, or if there's a massive financial event caused by a stupid chancellor and prime minister, then we might need to. But generally, we don't put any money into the purchase price, only to stamp duty and the legals. So by doing that split, it's forcing it upwards. It's it's the equivalent of the HMO landlord buying the rundown HMO and adding the ensuite and making it beautiful to get all their money out. So it also gives us the flexibility down the line, right? That we could sell a couple off and, sort of have that flexibility. And, if you had a block of 10, maybe you could have 9 mortgaged and have 1 unencumbered, which is such a useful thing to have for, using it as a deposit at an auction or something like that, for lending at an auction. So, yeah, we do it really to get 100% funding. So if the deal's so good that we don't need to do it, then we wouldn't. Otherwise, I've never bought a block of 2. Tried to at auction, didn't win it, but yeah, we'd split a block of 2 if the numbers worked.
So it's about looking at, if you can try to get to that money in, money out via whichever route. If it means you don't have to split, then don't bother, which is what I had on mine. That's just the way it's worked. And I didn't fancy doing, 8 mortgage applications or, all of that sort of stuff. It didn't need to be done. But equally, if that's the route that makes it more money in, money out, and you've added the value that way, then that is the way to go. So it is a pure spreadsheet exercise, isn't it?
Yeah, and surprisingly now, there's some direct to title split mortgage providers. So that makes your costs even lower again then, because you've got it's great when you do buy them on bridge if you can service them off the income, because then obviously it doesn't
Yeah.
really matter that you're on bridge, right? It's just you're just sort of pushing the income bit a bit further down the line while you deal with the bridge. But yeah, there's now mortgage lenders that will lend you. I mean, it's not on their website. You can't just Google mortgage for title split, but there are some out there if you've got the right brokers. And that means that, and their valuations are typically a little bit more sensible than one that you get from the VAS panel for a bridge lender as well. So then it's really straightforward. It's like you go and instruct, or the lender instructs the valuer. If you get the green light that your value is correct, you've only gambled, say, £500 a unit on the valuation. And at the point that it comes back with a thumbs up, the rest of it's just the normal, basic, boring conveyancing process that we always all go through. And at the end of it, you've got this block of flats with however many thousands, net income each month. And you haven't even got the stress and the expense of a bridge in the background.
So really for you, the key to all of this is having obviously your solicitor in place who's going to be able to do the bit at the front end, at the back end. But the finance is the thing that's made this work for you in terms of the products that are available.
If you had a load of cash, it would be even easier again, right? If you were someone that had, £500,000 in the bank, blocks of flat to buying and selling for in your area, say it's £500,000, then it would be fantastic to go along, buy these in cash, title split it at your leisure, and then get finance at your leisure onto mortgage, never have any bridge fees or the obvious hassle and that goes with bridge, and then get your 500,000 back when that would be the best way of doing it. Bridge then was obviously a necessary evil when it was the only option. And now with mortgages as well, it's like, yeah, it takes that complexity out of it. And then really, as you say, it's understanding the finance market to get the right products. You're right. Having a fantastic solicitor, which I sort of take for granted because I've got some fantastic solicitors, but if you haven't got a fantastic solicitor, that is a problem. And The other bit is the valuation. That's a huge bit of it. There's two parts to that. The first part is you being able to accurately predict what the end valuation of an individual flat is, so that you're not wasting your time and money each process going into this and then being told by a valuer, no, you're wrong, it's not worth that. And then the other part of the valuation is, of course, sounds arrogant, but the valuer getting it right, because there are a lot of companies out there that have very inexperienced young valuers who will come along, and they're 'cause quite often they get sight of what you're buying it for. So if you're buying this thing for 1 million and you're saying it's
And they can't move away from that.
no, and they're terrified that their boss is going to tell them off, or they're going to get sued, or their PI is going to get hit for the difference. So versus you get an older, more experienced valuer out, and quite often it's the smaller agencies where the guy that comes out is the director, the valuer, and so on and so forth. And they're a bit more like they will just look at it and say, right, average square footage in the area is this. Oh, you're asking for the square footage in the area, and well, your flats are quite average, or maybe they're nicer than average, so what's the problem? Yeah, of course it's worth that. But that you can get derailed on the valuations quite easily. And then you've got to sort of say to yourself, do I go in again with a different lender or a different valuer?
And yeah, which is of course always possible, and what we have to go through for a lot of different property things. So let's focus on the sourcing of these amazing magical properties. So we're looking kind of for potentially 6 up to whatever in terms of unit size. You've bought ones that are clearly all right inside. They might not be absolutely spanking, but they're definitely not, absolute mingers, and that you have to spend an absolute fortune on. So these are ready to go rental.
Very often tenanted. Yeah, usually tenanted.
Yeah, because then you can service the bridging loan, hopefully that that it all works out in that way, or at least helps you a little bit. So what else, when you're looking at these properties, what else are you after? Is it a reasonable GDV area, as in not too run down? What's the magic around that one?
So it is a little bit case by case, but the things that I suppose experience has taught me over time, flats under 30 square meters are hard to mortgage, full stop. Title split, whatever, they're hard to mortgage. So try and avoid the ones under 30 square meters. Studios, unless it's like, central London or whatever, or, overlooking the coast or something. But studio is generally a posh word for bedsit, isn't it? So, so those aren't going to value as well. So 1 beds and 2 beds are definitely bread and butter. We only look at stuff really where the utilities have been split already, because,
Yeah.
and that's probably, again, a really important thing to note, for all the listeners, is when we're talking about this split process, it's just a legal process. It's just a pen and paper exercise. We're not dividing utilities. We're not bricking up any doorways or anything. We're quite often not even having a painter sent in, depending on the condition of the flats. And so, we've never bothered with having to split utilities ourselves, because quite often you're in a back to brick situation there. So you might as well have just bought an old office block and converted it, which is obviously a completely different topic. So utilities split, 30 square meters or below. Coastal locations work quite well, and it doesn't have to be your expensive, it doesn't have to be Brighton or Sandbanks or something. Actually quite tired old seaside towns can work quite well, because the blocks of flats are very affordable, but actually, there's still a workforce there that need affordable accommodation.
What about the value? So obviously with that example that we spoke about at the beginning, you were buying them 5 grand each, and then you uplifted that to probably what, about just under 60?
Yeah, about that. Yeah.
Yeah. So you've got an uplift of whatever it is, like about 40% or something like that, was it?
Yeah, I think generally we uplift between 25, obviously being the minimum to get the 100% funding, and then I think the best one we've done is about 44, 45% uplift, something like that.
Yeah. Okay. So that's an important metric, I think, for other people to understand as well, that if you're, just doing that straight back of a cigarette pack calculation, if it's a 25 to 40, well, 25 to the sky,
Yeah.
up, then you're looking at being okay in that deal.
Yeah, and as a rough rule of thumb, you say you're looking at something for 1 million, you want to be able to times that by 1.35 or 1.4, and that gives you the headroom then to know you're going to be able to do it.
And then the back end lending, so you went with Shawbrook for the block of 40 and they did it all, which sounds wonderful. Will Shawbrook now do more for you, or were you overexposed with them?
We did another block of 5 this summer with them. I think we might have had to have an extra interview or something, an extra Zoom call to, just I don't know. I don't know what I do wonder sometimes what it is they're trying to sort of get out of you on those calls, but we passed it. So whatever it was, it was okay. But yeah, we did hit some sort of extra check. I remember that due to the amount that we already had borrowed with them.
And is it always ideal for you to find that lender who will do the whole lot? Because obviously it's less paperwork for you and less fees as well, because it's just the one fee and one legal fee and all of that sort of stuff, even though it's, I'm sure, elevated a little bit. Is that the ideal to try and find?
We tend to lean towards the ones that will do the whole block, but actually the broker I use now, who's absolutely fantastic, he's sort of saying, especially on the big block of 40, for example, that one he wants at the end of the 5-year fix, he wants to chop it down into smaller parts. So I think he's thinking maybe 4 or 5 different lenders. So not too much hassle as far as signatures and stuff goes, but to hopefully knock, I don't know, I think maybe he's thinking 0.75% off, which on that sort of size of
Is
loan
big.
is worth having, yeah. Whereby, if it was a smaller debt, you might just say, I can't be bothered, and go with a slightly more expensive portfolio mortgage for convenience.
Yeah. So I think what I've sort of picked up from you over our chat today is actually the whole title split bit is not too much of the onerous part of this process. It's more making sure that the finance is in the back end and the conveyancing process, essentially.
Yeah, I'd say the 3 things, if you can be amazing at these 3 things, you will succeed in title splitting. It is finding them in the first place, because that is, things like HMOs are all about the hard work comes after you buy it, isn't it? It's the planning and it's the the conversion and the project managing the builders and then the tenants coming in and then them arguing with each other, and it's hassle forever, right? But with title splits, the hassle is finding the right block in the first place, and you get better at that over time, obviously. So finding it, that's the hardest bit, perhaps. The valuation piece, which you can teach yourself to be a better valuer. That's definitely a skill you can acquire. And you can teach yourself to pick the right valuers. But obviously, if you're going via mortgage, if the lender sends out, the grumpy one that always undervalues, then that's it. You can't do anything about it. And then, it's that. To be honest, the lending bit is easier and easier, and the conveyancing is easier and easier. Those 2 are the ones that stand out. It's finding the right one in the first place, and then making sure that your valuation for your deal stacking is correct, and that the valuer that comes along agrees with it, effectively, rightly or
Yeah.
wrongly agrees with it.
So I think I'm going to leave this on a teaser then, because I think we need to chat again, James, and we need to maybe chat about how we do find the sourcing, because everyone's going to be like, well, if that's the 2 biggest things, tell me all about it. And we will, but we're going to do it on another episode.
Sure. Yeah.
It's been fascinating chat with you today. I love the fact that you went so big on that first life-changing, deal. It's going from 5 properties to 45 overnight is not something that many people do. So hats off to you and Laura for that one. That's absolutely amazing. And I would definitely love to chat to you again about that. But obviously you do offer a consultancy around title splitting as well. So if people want to get in touch with you, what's the best way?
Yeah, great. So if you throw sort of hashtag the title split consultant into Google, no spaces, just hashtag the title split consultant, you'll tend to find me on most channels, but the place I'm most likely to be found is LinkedIn. So I'm James Lynch, Lynch, or hashtag the title split consultant. Yeah, LinkedIn mainly.
Amazing. Well, thanks for such an insightful chat today, and hopefully some people have got some inspiration and some practical ideas of where they can, go off and do this strategy for themselves. And keep tuned, because I think we're definitely going to get James back, and we're going to talk about some real nitty gritty of sourcing those deals, and when maybe looking at case study and is this a good one or is it not. So I'd love to do that with you again as well.
Great. Yeah, let's do it.
Amazing. Thanks so much, James.
Thanks, Sarah.